How much do you think a unit grows in capital value compared to a house? Hi, I'm Sam Powell.
And I'm Jared Krause, and we're the hosts of the Property Pals Australia podcast. And in this episode, we're discussing some recently released data on the growth rates of units versus houses in Australia that you really need to know as a property investor.
Yeah, we also discuss understanding the opportunity cost of buying local or somewhere else in Australia before you even decide to part ways with your money.
Yeah, I like it how we were able to also break down which is a better investment, buying a house or actually buying a unit in Australia.
Yeah, there's some really good examples that we share of when to buy houses and when to buy units in your property portfolio.
We also discuss some recent examples of high capital growth opportunities that have happened in Australia that you could also tap into when you get your investment strategy right. Now, before we get stuck in this podcast episode, obviously we're talking about investing in property and buying a property, and to do that, you want to get the maximum amount of borrowing capacity you can from your broker. How we help people do that is with our mini course on how to maximize your borrowing capacity. If you want that, head to propertypals.au/resources. Grab this tool and help yourself buy a superior asset and achieve a better ROI. Get that at propertypals.au/resources, and there'll be a link in the description too. Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jared, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. Houses and units. Let's go.
Yes, it's a common question that people go through in their minds. I know I went through it in the investing journey or even in the owner-occupier journey. Which is best? Common question.
Yeah, and it depends on where you're at in your journey, right? I guess we should start from somebody starting a fresh portfolio and sort of identify like what their goals is with their portfolio in say 10 years time, because that will help then determine, like, there's so many variables on like when you should buy a house, when you should buy a unit, at what stage of your property portfolio, like property number 2, 3, 4, 5, 6, 7, should it be a house property, a house or unit, or like there's so many variables. So,
yes.
Where should we start? Like, what's the most common, you speak to a lot of these guys and they're like, they want what, a couple 100K or 100K passive income in 10 years, is that right?
Yeah. That's always the goal, isn't it?
Okay.
It's definitely achievable. It's, as we mentioned in previous podcasts, it's a more active strategy, and everyone's different. But often people are just discussing, well, do I buy this house in the further outskirts of my town, or do I buy the unit in the area that everyone wants to live? Because there's that scarcity factor of being close to the beach, as a classic example here on the Gold Coast. And my answer to that is, well, I don't just look on a Gold Coast base, I look at Australia-wide. So there's a few statistics around units and houses which we'll cover just to sort of paint that picture around it, because the ultimate goal in any portfolio is
cash flow
and
capital growth.
Yes. Yes.
Capital growth, well, it depends on how fast you want to grow, right? I'm capital growth at the start, and then I'm going to be cash flow towards the tail end-ish of it.
Yeah, well, generally capital growth is always the key for me. Like, everyone should be aiming for capital growth, but cash flow is what helps you, get to that financial independence, right?
Also, cash flow helps you continue going too, hey? Because like if you buy, say, like 3 properties at 90% LVR and they're all sort of like kind of negatively geared, and you've got the money to put into them, like maybe $100 each week, so you're spending $300 a week to keep these properties going, and they're growing in capital growth, but it's not going to help you as much as something that's getting a little bit of cash. Like one of those is getting a little bit of cash from, say, a unit. That's going to help you get borrowing capacity to go again, right?
Yeah, I call it the sweet spot, which is capital growth and cash flow. everyone's got their own little terminology for it. This is mine. I came up with it this week because I was trying to put some content around for a media piece. But yeah,
a sweet spot.
It reminds me of the surfboard.
Yeah, I was going to say, our mate Parker, he's got a sweet spot. It's a surfboard model.
Well, if you listen to this, Parker, I wasn't thinking of you when I thought of the sweet spot. Anyway, back to it. Houses or units. So a recent article actually came out from Domain, and they actually looked into a lot of statistics around how houses have performed against units. So
let's go through some stats,
some figures. Okay.
So at the top, I guess.
Yeah. Well, the first point that was echoed on mind was they were measuring, the length of tenure. So that means how long people are holding things for. Houses, on average, are held 1 to 4 years longer than units, and that's 1 to 4 is based on all the major capital cities. But for the average, it's around that 3-year mark for an additional tenure.
Okay, so people typically hold houses for 1 to 4 years longer.
Yes.
Than a unit.
Yeah.
Okay.
So what I look at that and go, well, as a livability perspective, people are more aspirational towards the houses, so they're less transactional. There's more scarcity, so therefore that's what I'm always hunting for in an investment is scarcity.
That's a good point. That's a really good point.
And
investing.
Yeah, well, that's supply demand metrics, right?
Yeah.
So everything comes back to supply and demand, which sounds pretty simple and boring, but it's then you start digging further and further and realize it's a lot more complex. But
why the supply and the demand is actually like that. And the reason here, like you said before, is because they're homes and people typically want to stay in a house longer than they want to stay in, say, a unit.
Yes. Yeah, like
makes sense.
There's always the
more living area, just a bit more comfortable.
Yeah, my wife and I are having a discussion, do we move to a unit on the beach?
Do it.
Or, stay in our house. And
it's a good chat
to
have with the family.
Well, for us, because we got little kids, I mean, don't get me wrong, my preference for me, just as a personal preference, would be to be on the beach because I can check the surf and go out the front.
Yeah.
But I got 2 kids, and the joy that we get from watching them, one, we don't really want them in the house all the time. We want them, but we want to be able to see them, right?
Yeah, so that's what I mean. Like, if you were to go and live in the unit, you would be able to take them to the beach every day, but then you'd have to leave your unit every day. Whereas you got your backyard with like the play sets and the veggie garden and
all the stuff you accumulate.
Yeah, all the stuff, right? But it's like it's all there. You built your own like little city environment,
a little play center.
Yeah,
it's crazy, man. Like before I obviously got married and had kids, I was very similar to Jared, where we just didn't like having things because it held us not held us back, but it was just difficult for us to just pack up and leave.
Yeah.
And now I'm doing the mental shift where it's just I don't need to be traveling around and moving different locations, living in different countries anymore because I want to be in a base for the family. But
you want to spend your time with the kids while they're young.
Yeah, absolutely. And anyway, so come to the conclusion that the beachfront can wait. I'm only 34. I'll keep the backyard.
I think it's a relevant point for us to talk about this because this is the natural way that people progress through their life is they get to a point that they have kids. Like 90% of the world, maybe more, 95% of the world, as they find a partner, if they get married, they're gonna get a place together and get kids, and they're gonna want to stay in a house longer. I know people are living in a unit, in my block here, and they do it and they love it, but I'm sure they would prefer a house, right? So it's definitely that preference of more houses staying off the market longer than, say, units because people enjoy staying in them, and that's where most of the people are heading to. That's where most people's goals are between 25 to 40 is, having a family. So there's the stats with that. What other stats have we got?
Oh, another one. This is a really key one because obviously we're talking about capital growth, right? Like that's a major goal for any portfolio. In Sydney, and obviously Sydney's just an area, but it is the major capital city in Australia, and a lot of the data from there expands out to the rest of Australia. But in Sydney, the capital growth rate for houses from 2013 till present, 2023, it was 122%. So, growth rate. So, reasonably good growth rate from that on a median basis. Units in comparison, whilst it was the data was collected from 2015, so 2 years less, but the growth rate for units from 2015 to now was only 11%.
Oh, that's massive. Let's also put a big disclaimer out there on this, that this is one area in Australia, and that's Sydney, and that's where most of the data, Melbourne and Sydney, where most of the data is obviously reported, right? And that's not all of Australia. So 122% growth rate in houses, and then 11% growth rate for units in Sydney. Other areas, I'm sure Brisbane's different. I'm sure Melbourne's different. Perth's different. And then you've got other areas within those areas as well. So don't think that's like just across the board, but it's very, I would assume that most places in Australia have a similar amount of similar stats, or at least knowing that it's highly likely from what we said with the tenure of the houses that the growth rate of houses is going to be more so than a unit in probably most places in Australia.
Yeah.
Would you assume the same?
Yeah, and like the
data based on the data that you're looking at way more data each day than me.
Yeah, the data's always skewed, right? I'll throw another stat out there to you shortly, but I just wanted to stay on this point for a bit. It's units that can be recreated. So your definition of a unit, you can knock down a house and build 2 duplexes, and those are considered units because they're strata title. You can build more townhouses. You could knock down townhouses to build a whole unit complex. So the downward pressure on units from a data point is always there.
Such a good point, because you can always create more units more easily than creating or building a house, because you need a bit more land for a house than a home.
Correct.
Wow, that's
and
cool.
It's more profitable as a developer to increase the density of the site based on the zoning.
Which means more units coming out, because property development's great for people's egos.
And money. Bank
yeah.
all. Not all developers. Sometimes they go bust, but the ones that get it right, they have the houses on the beach.
Yeah.
So they got the best of both worlds.
They sell units and live in houses.
Yeah.
So wouldn't you want to be selling your house to a property developer?
Or be your own developer. Anyway. Yeah. So really interesting statistic that I picked up, and it's just something to think about on the back end. Like another one that was thrown out there that it was interesting, but it also paints a really positive picture, because units do grow in capital growth, right? And we're looking at, as you said, it's an individual unit, and there's so many variables, but if you can find a unit that's really scarce, then you get good capital growth out of that as well. Your issue is just that scarcity levels are not as high for units as are in houses. Does that make sense?
Yep, absolutely.
Yeah, a good point from that report as well was the profit levels. So I'll just read them out because they're actual numbers.
Great.
Today, 97.8% of houses sold for a profit, and 91.7% of units sold can resell it at a profit.
So a 7% difference.
Yeah, so both still obviously profitable in that sense.
That's
but
average around Australia.
Yes.
Okay.
Yes.
Cool.
In the major capitals.
Major capitals. Okay.
So that's Sydney, Darwin, Melbourne, Adelaide.
Yep.
We've got Perth, got Rattleball off, Hobart, Brisbane.
Gold Coast.
Goldie's not a major capital.
Goldie's pretty major soon. It's just like close to major, isn't it?
Well, Gold Coast is basically it's Brisbane. Like people will look, Brisbane, because you look at Sydney.
Yeah.
Like people are living in Sydney, they go down to Cronulla. That's just like the same distance away from the city that is the Gold Coast, and it's like, Cronulla's part of Sydney.
Yeah.
And as a Gold Coast local OG Gold Coast people, we don't want to be associated with I guess Brisbane. We love Brisbane, but it's just that, I guess, the rivalry that you have with your neighbour, where especially the football teams and everything. But it's changing. Brisbane actually, check out the plans and what they're actually building. It's going to be a pretty beautiful city in the by the games in 2032.
For sure.
Anyway, there's another statistic.
Let's not give away too much investment advice around Brisbane.
I like
guys.
it.
I'm joking, guys. Obviously, if you're smart, you know that Brisbane's going to go off.
Yeah, it's already going off.
Yeah.
Oh man, I'm still like looking around Ipswich region. I still see good growth in it, and you're happy. Put it that way. I keep thinking of you.
I was speaking about that property to my sister just yesterday.
Crazy what you can do in 12 months.
It is. It's crazy. So let's. I do want to talk about. We'll do this in our next pod episode. Examples of buying a home and buying investment property, and what I was talking about with my sister. I think that's pretty relevant.
Yeah, we'll do that on the next one.
Next pod. But for this pod, let's keep going through these stats, because I've got some more questions and more things that I want to sort of digest and process and help people go through as well, and understand like what they should be doing with their property portfolio on houses versus units.
Well, another stat which is really important, because it's also all the combined capital cities in Australia. Over the last 2 decades, houses have grown 209%, and units have grown 121%.
Oh, that's almost a double. Houses have grown almost double than units. That's massive.
Yeah, once again, aggregate data, units, houses, there are more scarcity, but another key factor to factor into your thought-making process. And like I say, it always comes back to, well, you can recreate units. That's why there's always that downward pressure. Stick to the scarcity levels, and that's why for me personally, I prefer houses over units from a capital growth perspective. There are certain strategies that I prefer units, and that is looking into growth locations within, like say, the Gold Coast. If you can find something close to the coastline, well built out in a small unit complex that has that long-term development potential.
Keywords.
That's what I'm looking for.
Yeah,
because you're getting decent cash flow out of it. Generally, they have a higher cash flow than houses. You're taking that strategy of waiting for a developer to come and pay you a premium, which does happen. You just want to increase those opportunities by having as little units in that complex as possible, and that land as large as possible. So they do grow in certain circumstances, really quite well. So
there's typically those old unit blocks that are quite small on a large block of land.
Yeah, walk up, no real pull,
like 6 to 8 sort of units.
Yeah, I like to try and
too major.
Try and keep it around 12 or below.
Okay,
because it's just harder and harder to find now, because all the smaller ones have been knocked over and built on. So,
especially close to the beach.
So keep that in the back of your mind. I'm not pro either or. It's just I chase the capital growth in the individual circumstance. If you're wanting to invest, but you have an affinity with a certain location, and for your first one you might be not willing to go into a different state,
that's a good topic to talk about.
It's an interesting play, but it also depends on budget as well. So, if you've got a broad budget and you can afford something that is a house in a similar location, I'd be looking into that. But there's different strategies for different people, as it always is.
Before we continue today's pod, I want to ask you a few questions. What is your property investment goal? What type of properties do you want to own? How many? What size valuation property portfolio do you want to own? And how much in net income do you want to be earning? Essentially, what's your magic number in passive income that you want to be earning? And do you know how to get there? And if you do you know how to get there in the least time possible with the least amount of risk?
Sam and I have been helping people invest in property and build property portfolios for years. People who are now replacing their income through property, and we want to help you do Same. Right now, for a limited time, we are offering free property coaching to our listeners. We won't be able to do this forever, of course, so head to propertypals.au/coaching. That's propertypals.au/coaching to see how we can help you achieve your investment property goals. Link will be in the description too. You mentioned the affinity of staying in a location that you are close to. Like, what goes through your head when somebody's like, yeah, I've got X amount of money, borrowing capacity, and like, I want to buy in this area, and my goal is as much capital growth. I don't care where the property is. You know, they say they don't care where the property is. They don't care what the type of the property is, but they just want full capital growth. And then they're like, yeah, but like, what about these areas that are close to me? And you're like, what goes through your head? Like,
yeah, good question. Good question. So,
because like, say somebody's got like 500 grand, you know, and they're like, yep, let's buy something.
I'll do a case study for you because this is really relevant for a mate that I'm helping out at the moment. And
well, it's relevant for so many of our mates.
So,
and your mates too that are listening. It's like, yeah.
So my strategy around that is you get certain benefits from if you're willing to live in that property for 12 months, or you can buy it, and you want to be, your principal place of residence right off, but then you want it to be an investment.
Yeah.
Within that 12-month period.
There's the capital gains tax. So what is that capital gains tax like savings?
Well, if you buy it under your principal place of residence, you live in it for 12 months, then you rent it out. That's now an investment property, but you've got the 6-year tax ruling where you don't get any capital gains tax on that property. So you can hold that for 6 years and sell it.
And not pay any capital gains tax.
Yeah, from when you rent it out and to sell it. So you can hold it for a whole total of 7 years and sell that thing and only have lived in it for 12 months.
Mm-hmm.
And you get all the tax write-off because it's an investment property. Mm-hmm. And general advice, speak to your accountant. Mm-hmm. And then you also don't have the capital gains component when you go to sell it in that 7-year time frame. So you don't need to perform as well on a capital growth perspective because you don't have that tax component of your portfolio. And then even after those 7 years or 6 years when you've held it, just get the valuation and then obviously come have a chat to me, because then I'll assess, well, where's that current market at? Because
into other areas, and what's your opportunity cost of investing somewhere else, right?
Yeah.
With that money that you could get, because that's where you have to weigh up the costs of, do I hold it or not?
Yes, 100%. So that's the key point that I'd be looking at units in your area, because there's the benefits. You can get stamp duty relief. You can get there's the super saver scheme where you can pump money into your super, pull that out, and use that as a deposit. There's a lot of benefits to get people into property from the government perspective, because they know. Yeah, and that's always changing. But that's a really good strategy. I just throw out there.
It is good. Like, what our mate's doing is smart, right? He's if he sells it in 6 years and can get into a different area, like great. What about if they decide to hold it for longer than 6 to 7 years, or say longer than 6 years? Then is it 50% capital gains tax, or is it full capital gains tax?
On that period of 6 years, from when you say you moved out 6 years later, get a valuation done on that day, because if you go to say sell it in 4 years' time, so the total hold period you've had on that property is 10 to 11 years, you're only paying the capital gains component from that last 4 years.
Great.
So by getting that
and that's full capital gains tax on the last 4 years of growth.
Yeah, and when you're talking to the valuer who's going through and valuing it, make sure they do a high valuation. So you have less capital gains tax on the back end.
Just call up Sam Powell. One of our mates' names Charles. Call him up, he'll hook you up. We've got to get Charles on the pod, actually.
Oh yeah, he's
listening to this, Charles. We're coming for you.
He's camera shy, but
I drove past his house yesterday and saw his boat. I was like, oh damn, we haven't had him on the pod yet.
Yeah, you're good with that. I'm a terrible networker.
As if you're way better at networking than me.
Anyway, so there's a bit of a free strategy I thought I'd just throw out there, but
that's great.
And once again, I caveat that with I see a lot of good growth potential coming into the Gold Coast in the next few years. Therefore, I'm confident that is a great opportunity for that person's particular budget and what they're trying to achieve. So that ticks that box. That was a long way of going about it, but
But that's okay. So let's get back to the unit. Houses conversation and stats.
Yeah, well, they're the main stats that sort of paint that picture that houses statistically grow better than units, and in my experience, they do. And it all comes down to, personally, land is scarce, finite. We can't build any more of it in Australia, unless you're building out islands and things like that, which they do, but very rare, very expensive. So point being is they're not able to create more land, but people desirable. They want to live on a bit of land, have a bit of space. The unit component, you can knock down that one house and build 50 units. Okay, cool. That means that your scarcity levels are really low.
Mm-hmm.
So historically, that aspirational house is where people want to be. And if you see the progression over time, the wealthy people tend to want to have that little bit of security and have a bit of land, have multiple bedrooms, and also from a strategic point of view, when you jump into that next, wealth bracket, you can store a lot of your value in your principal place of residence and you've got no tax implications. They don't look at that for any benefit funding. As an example, if you're retired and you're wanting to get the pension, they won't assess your principal place of residence. So you could live in a $10 million principal place of residence, all debt free. But if you've got no other income coming through, you can be eligible for pensions. So little strategic play there to future proofing, and that's why working with good accountants and having those questions that start making you think, what's the next 10 years? Because you're going to be here in 10 years, 20 years, 30 years. So think that way.
Yeah, so it really comes down to houses are growing typically more because there's less supply and more demand for them than, say, units. If we're just going to sort of conclude all of that data, that's very broad. Then it comes to the question, Sam, of all right, well, do I just buy as many houses for my property portfolio as I can? And then at what time do I get stuck with houses and not much cash flow from them? So, somebody that wants to get to 100K passive income in 10 years and they're starting from day dot, when do you add a unit in?
Oh, good question. Generally not.
Cool. All right, why?
Well, as we just spoke about, if you want the best
capital growth,
but
what if you get to year 8 and you're like, I've got some houses growing and you've got 80% LVR on most of them, you haven't paid down too much of them.
Well, then you'd be looking at you're taking a little bit more risk for the potential return. So then you'd be looking at, well, let's go shopping around for, those unit sites that have that development potential where, it's a little bit, it could be a bit more of a lifestyle play or a Airbnb cash flow play. And, you are, the strategy is to go in to sit on it for 10 years for a developer to come knocking and pay you that 100 to 200K premium. Or I think it was about 10% premium generally where it runs off. So it's like, well, if that's the case, you don't want to bank on that, right? Because that's an event that may never happen. Whereas if you've got that track record, you've got a few houses in your portfolio, you've got a bit of commercial, you've got good cash flow, and then you're sitting there going, well, I'm a little bit bored, and I want to buy again, and you might really love an area, and it's more of okay, cool, well, let's have a look at this unit. It hits that target in your strategy, which is a 5% income and we're targeting at least a 6 to 7% capital growth rate. If the data is suggesting that, then absolutely, let's jump in. There's been scenarios where houses grow so much faster and units have that lag period. So if you're looking at the data, that's when I look at it and go, well, houses are kicked, and then in order to get into this location, you need $2 million, but you can buy a unit here for $500,000. That doesn't make any sense. That is good value. That's when you shift into the well, let's be a unit investor. And if you're being the unit investor, I'm talking duplexes, maybe a townhouse in a small complex, or a detached villa in a small complex where
not a 50-story walk up.
no, definitely not.
Not walk up. I mean, you're not walking up 50 stories, but you know what I mean. 50-story high rise.
Yeah, it all comes down to scarcity. So you go, houses are the most scarce. Houses on bigger land are more scarce, and then houses, and then duplex because you've got two, townhouses because you can have a couple, and then units in small complexes of 6 to 12 is generally the preference. And then you go into, well, there's no point in buying it into a medium rise or a high rise because it's too modern. The depreciation of the improvements are much greater than the appreciation of the land. Yep. So it's working against you.
Cool. So let's just say the average Joe that comes to you guys and you're like, yeah, we want to get you that 100K passive income in 10 years' time. What does their buying strategy look like over those 10 years, and what sort of assets are they buying? Is the average person just going, yeah, I'm just going to buy a house every 2 years, and they buy 5 of them? Or when do they chuck a unit in? Or like, what's the average sort of property portfolio journey look like over a 10-year period?
Generally,
for an average person.
For an average person, you break it down, 100 grand in a year. If you're looking at, that's $2 grand a week. From looking at that.
Yep.
So if you're looking at that, that's 4 houses renting at $500 a week, debt free.
Debt free, yeah.
So that's your accumulation phase. So I like to look at that and go, well, those 4 houses will get you to that 100K passive. But if you're leveraging up to an 80 to 9% LVR, you're not going to be able to pay all that debt down within a 10-year period. So you're going to have to accelerate it by going into a commercial play. Or a high income play. So that could be, when I say commercial, mainly around the commercial loan structures that cover it, which they obviously cover those industrial properties, office, retail, the rooming house accommodation where you've got 4 or 5 micro apartments where people are paying your rent. And then you've got the unit complexes. So you can buy, say, a row of 4 townhouses. So you own the whole site, but then you've got 4 properties and they're giving you a higher income. And that strategy really depends on where you're at in the current market cycle, because they perform differently. Everything ebbs and flows, which is the best asset for your portfolio at the time. And then there's
you can get in borrowing capacity as well. For a commercial, because commercial, different kettle of fish than residential. It's you need a far higher barrier to entry in terms of needing like 40% of the property price in sort of cash for purchasing, deposit, and entry costs.
And that's the whole idea, because commercial, you require that high deposit rate. The foundations of your portfolio start with residential. They're the emotional buyer. They are the one that, because there is scarcity in these areas and the data helps us points you into the right location, so you're getting that good kicker at the very start of your portfolio. That's what's going to help you. So it's not you constantly putting cash into your portfolio every single day to pay down your debt and to have that big enough deposit to go the commercial route. And you're just refinancing, pulling that equity out in, say, year 10, using that deposit, going into your commercial, and then that helps with the cash flow requirement, because commercial generally sits around, at the moment, 6 to 8% on a net yield basis. Historically, they were up around the 10, but from a income rate, that pays all your outgoings are paid for by the tenant. You've got on $1 million purchase, if you buy that requires a deposit of say 300 to 400K. Then it's, even at a 6% net yield, that's giving you 60 grand a year. So it's
it's best to work it off conservatively, right? Like even like a year ago, people were looking at 5% net yield.
Yeah, that's crazy time.
I mean,
you can still do, like,
when I do my calculations, I'm hoping to just get a 5% net yield, and if I get 6, I'm winning. like it's an
Right.
extra 10 grand in my pocket a year.
I wouldn't let you buy a 5%. Oh,
Oh,
if
no,
it's
no,
like
no.
it depends on the risk, right? Like if you're going into medical, then they generally run a lot lower.
I don't want risk.
Well, then you're
Yeah.
going.
I'm happy to take less money than risk, I guess.
Yeah.
Like, yeah, I just don't want risk.
There's always risk in investing, Jared.
There is. I'd like to take the least amount of risk.
Yeah, but the least risky are the ones that run on because the yields. It's going into many tangents, but the yields are based off risk in my head because
Yeah.
people are willing to pay more for an asset to get less of an income because of the risk involved.
Yeah.
So you generally see those places like chemists run on a really low yield, sort of medical, because you think about it from the economic cycle of a country. If we go down to like recessionary periods, which historically is always there, people pull back on their discretionary spending, and medical is something that people don't pull back on because it's your health.
Is your wealth, yeah. And also they want to stay in those locations, medical, because you know where the chemist is. If you need it, you just go there. But like, you don't want your local chemist changing every single time because like, damn, like I need something, I don't know where to go.
Yeah.
Right. So like that's why those leases are better, and those medical centers and chemists will hold those leases longer.
Yeah, well, I'm also thinking Chemist Warehouse have like an online situation now where you can just like, damn, that's why industrial and storage and warehouse is really interesting play at the moment.
You can't. I mean, maybe you will have dentists come to you, but I doubt that's going to be
Dentists?
Yeah.
Yeah, no, you need all. That's a good point. Dentists are good.
You need the chairs.
Yeah, I like
you
dentists.
need all the stuff, right?
Yeah, imagine a dentist just coming with a van. Could be.
Oh, I could.
That's a business idea.
That's a business idea, guys.
All right.
Would you trust a dentist in a van?
I don't know. Convenient. Like,
it's convenient, but like,
we'll check his Google reviews.
It's not going to be the nicest experience, is it? Just sit in the back of a van. Anyway, most people don't like going to the dentist. So what are we talking about?
Yeah.
Conclusion is properties for houses have a higher growth rate. So if you want higher growth rate, go for properties. If you want cash flow, go for units.
Oh, no, that's not my conclusion.
Okay, what's your conclusion?
My conclusion is if you want good capital growth, take the lower risk, find a house. But if you are pondering, well, that classic strategy I mentioned, which is you can buy the unit in that location that you're more a strong affinity towards, I would advise against it until I've seen the data set to understand whether that's the best use of your capital. Because even if you go down that strategy, what if that location does nothing in that 10-year period? Then you would have been better investing into a different location and actually getting that capital growth, selling down that asset, paying that capital gains tax if you may, and then going into another location to be more of a proactive investor. And a classic example, which at a really interesting meeting this week actually with one of Australia's leading data analysts, and there's a suburb in Berry, New South Wales, Berry. Check it out.
Oh, dropping some secrets on the pod.
No, you don't know what you don't know. Once you understand by looking at the data, and the historical performance, you're like, holy crap! Like it is life-changing stuff. So this location, Berry, New South Wales. Go on realestate.com. Go into the suburb report. See the growth rate from 2019 to 2020 or 2021. 2019-2020 period to the 2020 to 2021 period. They've measured in July. Anyway, it went from a house price median of $1.4 million to 2.38 in 12 months.
Wow, that's $1 million in capital growth in a year.
That's life-changing stuff, and that's like it happens more often than you think. But that there's obviously a really great example, so I wouldn't expect that level of return. But I mean, different locations around Australia that we're buying, and even in we paid $455 for yours. That was nearly 12 months ago. I mean, that's gone up, easy 25% since when we bought that. And so it's like similar growth rates because 1.4 to 2.38. That's looking at a 50% growth rate over 12 months, which is phenomenal. But
it's a great I'm glad you mentioned all of that, because I think it's a great way to wrap up the pod is, guys, before you invest, understand your opportunity cost and weigh up, do you go for a house or do you go for a unit based on your borrowing capacity and what the opportunity cost is on where you can invest that in Australia in a higher growth location. Or
Yeah.
because if you're going to buy a unit, you still want growth.
Yeah. Get out of your head. Don't think local. Think there's a whole nation you can invest in, and there's people that specialise in putting you in the right locations, and you just got to know who to talk to. So reach out. hello@propertypowers.au. I'd love to have a chat and make sure that you're getting out of this rat race or heading towards the lifestyle that you want. See you on the next one.
See ya.